Have you ever heard the term hard insurance market? It's a term that's coming or becoming really relevant. Everybody keeps saying it. And in this video, I want to talk a little bit about what it means from a policyholder standpoint, what it means from a broker or an agent standpoint, and then what it means for the carriers. So, in short, a hard market means a difficult market. It means a general retraction of the insurance market to the point where coverage is sometimes outright unavailable, difficult to get, or limited in some way. And certainly all of those things show up on the price in the price conversation. Costs generally go up. We have been in a cycle of a hard market for the property, I would say, since COVID. This is just my opinion of kind of what happened. We kind of entered this unknown cycle, and unknown is not something insurance companies really like entering the equation, because they're on the hook for a lot of money, and usually uncertainty works against them, not for them. And so we entered this weird period of what I would call was primarily social inflation, where they didn't know where the costs were going to go. They didn't know where things were going to go. And so they started raising their prices in anticipation of covering claims like business interruption that they didn't anticipate covering when they wrote the coverage. But then what happened was real inflation. We saw a real inflation spike. And if you think about it from an insurance standpoint, especially property insurance, the rates are issued at a certain level, and then inflation continues through the year, and there's escalators and stuff like that. But I will say that both carriers and brokers were guilty of not really paying much attention to property values. Certainly we did. It was in my opinion, the only thing you really have to make sure you nail on a property policy is, what do we have the building valued at? But I would say most of our industry is extremely passive. So they take the automatic 4%, sometimes 2%, sometimes 0% increase every year, and all of a sudden those building values are not even close to what they should be. And so, anyways, to shorten up the carrier side, what we saw was them realizing they are extremely behind the eight ball on the premium they're collecting versus what they're going to pay out, just for normal property losses. You had storm damage surge through that time as well in the Midwest, which has traditionally been the kind of saving grace for the property market as a whole. You've got California and the West Coast fires all the time. Then you have hurricanes hitting multiple times in Florida and in other parts of the East Coast. And so the Midwest was this kind of area where they could actually make money. That went away for a couple of years there. And there were some pretty drastic changes made. So that's all on the carrier side, and that's kind of abbreviated in itself. I'm sure people smarter than I could tell you a lot more in-depth knowledge of what happened there. But we saw a hardening property market. And now what I think is going to happen with litigation going crazy in auto, litigation going crazy in basically anywhere where there's kids or a sympathetic case to be heard. We're seeing a lot of increased litigation there. And so I think the hardening liability market is actually already upon us in certain industries. It will be upon us in every industry, I think, in the next 5 to 10, where basically that 5 to 10 area of umbrella coverage is very difficult to get. If you go way above that, 10, 20, maybe even 25, 30, you should be able to still find that. But we're seeing a hardening market there already. So what does this mean from a broker's perspective? Well, from a broker's perspective, you can market and market and market and market, which is the traditional model of insurance. Get quotes, try and get quotes. You hear a lot of no's, and you get a lot of declinations where maybe years ago they wouldn't have declined, they would have entertained it. You don't see the pricing coming down dramatically. There are no silver bullets as far as pricing. I will say the only strategy that works really well is if you've kept your powder dry, meaning you haven't over-marketed, you haven't sent out a lot in a lot of years, where you quote it every single year. Those companies are DOL. The carriers just say no very quickly and move on. So if you have not over-marketed, if your claims are in good shape, It might not even matter, honestly, if your claims are in good shape, depending on the industry. But if they're in good shape, then you can still maybe get some interest. And then the problem is that usually, even if you get good pricing, your policy terms are probably going to be worse if you've been with a carrier for a long time, because you're going to be grandfathered into certain policy terms and provisions that basically aren't going to be there again. The other thing that I think is important from this standpoint is you might take a sweetheart deal now and save even a lot of money, but those policy, like that new carrier doesn't have the relationship you had with the old carrier. So let's say you have that bad year 1, they might look to drop you right away. Now you might not be able to get back in with the old carrier. And this is a very typical conversation I have in a hard market, to say, yeah, we're taking a price increase, but we have really good policy terms and we have a really good relationship here. Maybe it's worth paying more for. And maybe it's not. That's a decision that the policyholder has to make. Finally, for the policyholder, it doesn't change much from a claim standpoint. I think that the the problems with claims, where you feel nickeled and dimed and stuff like that, I don't think that changes in a hard market. The bigger the claim, I will say, the more they look for potential exclusions or something to that effect. But I don't think that's really a hard market thing. I think that's just an insurance thing. I will say, if you have certain types, like rentals are very difficult right now. Habitational is very difficult right now in any capacity, whether it's a hotel, single family rental, apartment building, whatever. Very difficult right now. And so you may actually find in a hard market, you just don't have any options. So I could go on for a while on this. I'm going to cut it there because it's actually already a long video. But if you have experience with the hard market, or you have seen issues, they never last forever. I will say that. But I will say that it puts a lot of emphasis on, and I'm very thankful that our process, we approach things the way we do. In a sales model of quoting, it's really hard you'll get a lot of quoting opportunities in a hard market. You'll have far fewer successes writing new business and finding actual relief from that. So our process is really about risk identification, in which case it's meant to put our clients in the best position for hard market, soft market, whatever, because it's really about reducing risk and promoting partnership, which are two things that in a hard market, if there is a silver bullet, that is the silver bullet. So thank you very much. Have a good one.